Hello and welcome to Simplicity in Stocks. The sentiment among Indian stock market investors has taken a big hit over the last few months. What seemed like a solid bull market that would take the Nifty to 30,000 has now turned into a correction in which investors seem to expect the Nifty to fall to 22,000 or below. The all time high, just about 26,000, has been forgotten. Only a sharp change in sentiment in favor of the bulls can get investors talking about that level again. So, what happened? In this video, we will answer two questions. Why is the stock market falling, and when will the stock market recover? Before we answer these questions, please note that the video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now let's answer the first question. Why is the stock market falling? In one word, the answer is uncertainty. If you are an investor or trader, there is one thing you must know. All financial markets hate uncertainty. Currently, there is uncertainty about interest rates, there is uncertainty about earnings growth, there is uncertainty about Trump's policies, there is uncertainty about the situation in the Middle East. This uncertainty impacts prices in financial markets, be it the price of crude oil, gold, cryptos, bonds, currencies, and of course, stocks. This is why everyone is currently unsure about the direction of the stock market in the short term. In such a market environment, it is natural for the bears to take over the dominant role from the bulls. The bulls are just not confident these days, as we can see from this chart. Over the last few months, whenever the bulls tried to take the Nifty higher, they failed every time. During the bullish days of 2024, investors were getting far too positive. They were not paying attention to important things that affect stock prices. That situation has now changed. Investors are now finally paying attention to the important things. They are factoring in a growth slowdown in the economy as well as low growth in corporate profits. Investors are also getting used to the idea that earnings growth will not provide support to high valuations anymore. The idea was that the Nifty's high PE ratio was fine because earnings growth in the future would keep the Nifty PE ratio in check. Well, that idea has been correctly abandoned. There is also a sense among investors that major reasons for the market going up in the first place are now starting to unravel. Fast growth has been replaced by slow growth. Expectation of fast interest rate cuts has been replaced with the realization that rate cuts will be slow. Then there is the uncertainty about Trump's tariff policies and its second order effects. And then there are ever present geopolitical risks. No one knows how these things will play out in 2025. As I said, markets hate uncertainty. Now let's move on to the second question. When will the stock market recover? Once there is a feeling of certainty about the points already discussed, the bulls will return and take the market higher. Now, there is some nuance here that is important. The market can start rising again even without a resolution to the issues that is causing the uncertainty. For example, the current geopolitical concerns are not going to disappear anytime soon. Investors are not looking for a resolution to military disputes going on around the world. The market is looking for signs that these disputes won't escalate into wars that negatively impact global trade, disrupt supply chains, and cause a spike in commodity prices, especially crude oil. The same is true for the other issues as well, like the fallout of Trump's policies, the US Fed's interest rate policy, India's GDP growth, corporate profits, etc. This is very important to understand. The market is not looking for a rosy picture on all these issues. What the market wants is certainty. As long as the certainty exists, the market will be satisfied and will go up. Here is another example. Today there is uncertainty about falling GDP growth. No one knows when the growth slowdown will end. This uncertainty is causing even long-term investors to consider selling stocks. Now imagine that over the next few months, investors realize that the decline in the GDP growth rate has come to an end. They may not know how quickly growth will pick up, but that doesn't matter. The market will go up because the uncertainty has gone away. This is how sophisticated investors and traders put their money to work. They don't wait for a full reversal in sentiment from negative to positive. All they want is the negative sentiment to end. Now, this raises the obvious question: what will cause the current negative sentiment in the market to come to an end? Well, to be honest, no one on Dalal Street has the answer to this question. In fact, we believe that anyone claiming to know the answer with any degree of certainty is either wrong or lying. With that said, let's discuss how to invest in the stock market today. We believe you should follow Warren Buffett's famous investing principle: be fearful when others are greedy, and greedy when others are fearful. To find buying opportunities in the market today, look for fundamentally strong stocks where fear is at its highest. Fundamentally strong stocks with the highest fear factor satisfy the following two criteria. One, they should have fallen at least 20% in this correction. Two, they should be trading at low price to earnings PE and or low price to book PB. These are the best stocks to invest in right now. As long as all these criteria are fulfilled, you should be fine. Of course, you will need to do your due diligence as well. Check for management quality, corporate governance, past growth rates, future growth plans, etc. But the important point here is to start your search with those stocks where the fear is the highest. These will be the stocks that have fallen a lot and have low valuations currently. As long as you find these stocks, you won't have to worry about the recovery in the stock market too much. The market will recover because it always does. Happy investing.